Hello, everybody, and welcome. And so this is how stock compensation expense has cumulatively impacted companies with a focus on Meta platforms. My disclaimer and copyright notice: the information and opinions in this presentation are those of the author only and not the author's employers or affiliated organizations, including but not limited to Irvine Valley College and the South Orange County Community College District. The presentation is for educational purposes only and does not constitute any legal or accounting advice whatsoever. This presentation is copyright 2008 to 2022 by Bennett Tchaikovsky, all rights reserved. Any distribution is strictly prohibited. So what we're going to be talking about today is this project in particular. And essentially since 2006, companies have been required, when it issues a stock option to an employee, they have to report stock compensation expense. Now, the reason why this is of interest is that traditionally when you have an expense, and let's just kind of take a look at this. So if, for example, purchase, say, let's see, we enter into a consulting services agreement with a vendor whereby we will pay $10,000 for services for the month of February, we'll say January 2022. The vendor performs the services and sends us an invoice on 1/31/22. We pay the vendor on 2/21/22. So when we record this particular agreement on 1/31/22, when I receive the invoice, I'm going to debit consulting services expense, and I'm going to credit accounts payable for the $10,000. Remember, over here, we record expenses with debits, liabilities, and equity with credits. We increase our liabilities with credits, decrease them with debits, increase expenses with debits. Then once this is settled on 2/21/22, we debit accounts payable and we credit cash for the $10,000. So when I look at this, and you might be asking myself, well, what does this really have to do? Well, this expense is settled with cash. And what happens with this is that at the end of the year, all of our temporary accounts, revenues, expenses, and dividends will be closed out to retained earnings, which is part of owner's equity. Now, here we go, is we issue stock options to employees, whereby during 2022, whereby an employee will have the right to purchase 100,000 shares at $10 per share. Per the Black-Scholes option pricing model, the option expense for 2022 will be, we'll just say it's $1 million. Okay. Now, when a company issues stock options, think about it intuitively. When a company issues stock options, what happens? Do we have to pay cash to the employee? And no, and in fact, it's the inverse. The employee may have to pay us cash, depends on the form of the option. But again, it's one of those things where when we go through and we look at this, what would be my journal entry? Well, on 12/31/22, I would debit stock option expense. Now, here you have the consulting services expense being settled with cash. And that's what would happen. And this is closed out to retain earnings. Any expense is going to be closed out to retain earnings. But in our case over here, we're not crediting a liability because remember, if an employee exercises their stock options, this is now something that we just have to give them shares, not a liability. As a company, if we have a share plan, we can issue them shares through that plan. But over here, I'm going to be crediting additional paid-in capital common stock. And this is really where I'm going with this, is that as we look at this entry, in my opinion, again, in my opinion, right, I'm not going to tell you to not record stock option expense because I don't want to see you go to jail. We always want to do the right thing. And under the rules of GAAP, this is what we have to do. But the purpose of this project and what I'm having my students do this spring 2022 semester and a couple of my classes is that I'm looking at certain companies because I want to better understand about how much has it been impacted by stock compensation expense. And just so you can get a sense of how big the issue potentially is for some companies, is if we look at Meta Platforms, what you're going to notice about Meta Platforms on their financial statements, they're actually taking it a step further, which I applaud them for. Right over here on the statements of income, if you look over here, share-based compensation expense included in costs and expenses. So right over here, for the year ended December 31st, 2021, this amount was 9.1 billion. So if this was not, and this is deducted, by the way, over here, cost of revenue, right? This includes 577 million of stock option expense. Research and development, this 24 billion includes 7.1 billion of stock option expense. Marketing and sales, G&A. So in reality, is the net income really, if we're questioning this as being a true expense, which I applaud Facebook for Meta Platforms for pointing this out, what we're really kind of seeing is like, wait a second, this 9.1 billion is, this is not really a true expense. Now, as most all companies do, they identify the fact and they're adding this back when they're going through and doing their cash flows. So right over here, you see share-based compensation of 9.1 billion. But my issue with this whole thing is that cumulatively, and this is just to give you a sense of it. So what I went back through and did is I went through and I looked at Facebook's financial statement filings for the last, since 2009. They went public, I believe it was in 2012, but I looked at the financial statements since 2009. And as it relates to stock compensation expense, Meta Platforms has recorded a collective 39 billion. Now, why does this really kind of matter? Well, if we went over here and we looked at the financial, and let's think about this. So if I've recorded 39 billion worth of stock compensation expense, I was crediting additional paid-in capital common stock for 39 billion. This stock compensation expense is closed out to retained earnings, and it's going to reduce retained earnings. Additional paid-in capital common stock stays on the financial statements. Remember, when a share is issued for cash, typically what you would do is we can say Facebook or Meta Platforms issues, 30,000 shares for $210 each. The stock has a par value of 0.006. That's not even the right one, but let's just have fun with it. So when I record this, 30,000 times 210, and I'm going to go 30,000 times 0.0006, and I get 18. It's actually not the right number. Their actual true par value is going to be, let's use the right numbers, and we'll kind of play around with this. All right. So right over here, 0.12345. So 5 zeros. I was off slightly. Off by 2. So here we go. So this is like 18 cents. And so over here, you have this amount going to additional paid-in capital. What my point is, if I'm an investor and I am looking at the balance sheet, when I see additional paid-in capital, what am I really thinking about? I'm thinking about how much cash has this company raised by issuing shares. Now, the other part of this as well is when I come over here, and if I look at how much did Facebook raise in its IPO, and if we look at this initial public offering, market cap of 104 billion. Okay, so right over here, let's see here. Valuation and price targets. Let's take a look at this over here. Public trading. I think that the amount that was actually raised, I want to say it was about 16 billion. So Facebook raises 16 billion in the largest tech IPO in US history. So when we see additional paid-in capital common stock, right? If I'm looking at Facebook's balance sheet, is it really 55 billion from the cash proceeds? So what my purpose is of looking at this exercise and having my students look at it is to really see, okay, well, we have this issue out here where additional paid-in capital is being shown at this amount, retained earnings is being shown here. What are some different alternatives? Well, one of the things is that if we went through, if we got rid of the stock compensation expense and we basically added it back to retained earnings, Facebook looks like a much stronger company because its retained earnings are that much greater. Because again, the stock compensation expense takedown is not a good thing. Now, what I believe that Facebook should, or what Meta Platform should do, is that the better disclosure may in fact be to show additional paid-in capital, common stock from cash issuances, and then you have additional paid-in capital, common stock, other. And again, this would at least enable the investing public to know that, okay, did Facebook really go out and raise 55 billion? And the answer is no, it raised about 16 billion. This is an artificially inflated number because the cumulative impact of stock compensation expense shows Facebook is not nearly as profitable as it should be. Because again, it depends on what your view is of stock compensation expense. In my opinion, this is distorting the financial statements. Again, it's my opinion and I'm entitled to have it. So the background of this project is to really go through and have my classes go through public filings. I've put them into groups. They're going to be going through and looking at public filings. And after they've gone through and looked at public filings, I'm focusing on tech companies because they're, I think, the ones that have been the most impacted. I'll go through and publish those results for you and give that attribution work to the students. So hopefully this video can kind of show you where I'm going with this. But again, my goal is to give all of you a kind of a sense in terms of what is happening with stock options and what is this legacy impact on publicly traded companies that issue a lot of stock. So in any event, I want to thank you for joining me here today. Please feel free to reach out to me if you have any questions. I want to thank you all for liking and subscribing. I'll use a different, we'll go with a different font slide. If you have any questions or would like to see another video, please feel free to leave a comment. Not necessarily always going to be the best at getting back, but I do try to get back to my users as quickly as I can. Have a great day, and I look forward to seeing you on the next video. Have a good one.